Hey everyone, Mr. Anderson here. It's been a while since I have posted on YouTube, and I thought I'd give an update on Bitcoin and where it is in the cycle and where we might be headed to next. Currently, I have the 2 month chart up, and this is very useful for understanding the macro movement of Bitcoin. And as you can see here, it has what looks like the puking dinosaur pattern. You have the main body here, you have the long neck, the head, and usually we end up puking and the price comes down a lot lower. Now that's a semi joke. There's no such thing as a dinosaur pattern, but I have seen charts that look like this and they usually look a little bit dumpy. And why do I say that? Well, you do have a double top here, and you have a third top, which could be construed as a distribution zone or a third top, and this would be a triple top pattern. Now, we never want to look at one indication in isolation when we're analyzing our chart. So we want to look at our other indicators. We do have a 20 and 50 simple moving average on the 2 month. As you can see in the previous cycle, price did dump at our first peak, but never came down to our 20 SMA on the 2 month. If we're going to have a similar cycle, we could definitely come lower. And if we do end up hitting our 20 simple moving average on the 2 month, that means there's something wrong with the cycle. Either it's stunted or we're having a major pullback and then potentially having a second top. So that's just something to look at, really not something to worry about, but it is something to take into consideration. The other thing that I really want to look at is a market cipher. Now, when we look at market cipher, you can see, given the limited data that we have on the 2 month, we've had decreasing momentum waves to the downside. So there has been potentially a reduced return on investment every cycle. And I'm sure if you have studied Bitcoin and its cycle, you have heard this before. So that's something to consideration, that we may not be getting the same amount of gains that we did in the previous cycle. And if you look historically, you can see that every cycle has been a reduced return on investment on Bitcoin. The next thing we want to take a look at is our traditional oscillators. We have our stochastic RSI, we have our RSI, and our money flow index. Now, the one thing that I am concerned with is that we do have a cross on the stochastic RSI. And if you look back in May of 2021, you can see that the cross basically showed our first peak and what is considered our pi cycle high in the last cycle. So that does have me concerned. And the other thing that we need to think about is not only looking at several different indicators to come up with the picture of where price is going to come next, but also where we are in the economic cycle. So we had a lot of quantitative easing and reduced rates going into last cycle, where we are currently at the bottom of the Fed cycle, where we have very high interest rates and restrictive money policy. And I'll show you a chart that is very important to look at and show that the cycle for Bitcoin is very tightly wound with quantitative easing. So that's one thing that is in confluence, the economic cycle of the Fed cycle with our stochastic RSI. When it comes to the RSI, which is in purple here, you can see that we have descending waves to the downside. So we were very overbought at the last cycle high, or the pi cycle high, but we weren't as overbought, or we're not as overbought currently. So that's something that may be different in this cycle. And we can create a story from that, and the fact that, again, there's not as much money in the economy as there was back in 2021 when we had all that quantitative easing with the corona pandemic. Another thing that is different in this cycle is that we still have rising money flow going past the stochastic cross for this cycle. If you look at the last cycle, you can see that money flow peaked and RSI peaked with the crossing of the stochastic RSI to the top side. So what this initially makes me think is that we may have another cross to the upside. And a lot of this probably has to do with the macroeconomic situation and the events that we have to look forward to with Fed rate decisions, and potentially quantitative easing when it comes to the economy. So that's one thing that we need to consider. And the last thing that I want to take a look at is the MACD. And as you can see, we had a MACD cross the last cycle. And we currently do not even have a cross, although it does look like we are peaking. And that's just taking a look at the histogram. This is very subjective. It's not objective. But as you can see, we did have a peak in the histogram with the fast line above the slow line. And we currently have potentially that same situation occurring on the 2-month. So that's just something to consider. All right, the next indicator that I think is very important for the cycle to take a look at is the pi cycle indicator. You have a high long moving average and a high short moving average. The high short is the yellow line and the high long is the white line. And when those lines cross, it will give you the pi cycle high. So that's why we consider the first peak in the last cycle to be the pi cycle high. That's where those two moving averages crossed. And as you can see, there is quite a gap between the short and long moving average. That difference currently sits at around, we'll say 70% change in delta. So if we go back to the last cycle where this occurred, it was back in 2019. And what you're going to see is some very similar price action where we had a significant high from the low. We had what could be considered a bull flag or a banner, as it's a longer than a traditional flag, the way I look at it. And you can see the last time we had a difference between these two moving averages that came out to 70% after a peak like this and consolidation or distribution was the end of 2019. Now this fractal is very important because it kind of looks similar to the fractal that we are printing right now over the past 6 to 9 months. So this makes me think that we are in a consolidation distribution zone and that we potentially could have some catalysts to the downside. And these will be economic driven events, just like back in late 2019, early 2020. And you can see here, this was the response to the corona pandemic, and Bitcoin dropped a further 57%. It was almost a 60% drop. But if you take that from the peak right here, which looks like a recovery, that full drop was almost 63%. So during this time frame, there was economic issues that was preventing people from using their extra cash to put into Bitcoin. And leading into the pandemic, the economy was suffering. And part of that was we were having some inflation issues. The Federal Reserve had increased rates back in 2017 and 2018 and then immediately reversed those policies, trying to prevent the economy from nosediving. And Bitcoin suffered. And then we had the pandemic, and then they had to, shut down all the shops, close down the economy. Bitcoin suffered because people needed liquidity, and the first thing that they took was money that was invested in high risk assets, which is what Bitcoin is. And then right here is when, and I'll bring up the chart for this, the Fed cut interest rates significantly and injected quantitative easing. And I'll show you that in a bit here. But the next thing that I want to do is give you this fractal and compare it to the current fractal that we are printing on the daily. And you'll see how closely these two price actions are looking. All right, so here is the fractal overlaid our current price action over the past 6 to 9 months. And you can see that it pretty much covers the price action fairly well. You always got to take fractals with a grain of salt, but when you have such large fractals repeating over and over again, it's a sign of human behavior. And human behavior is usually cyclical, and they usually do the same thing over and over again. As you can see here, we have this pop, distribution, and dump. We have that same thing right here. We had a run up to a sell off, and then a second parabolic roll up, run up with the same little consolidation patterns as you can see here, and peak and a distribution zone where it forms a flag. This is more of a, you could say a pendant, but the action is very, very eerily similar. And the time span between the distribution zones are very similar as well. They're about 25 weeks. And we can take a look here from peak to current trough was about 26 weeks. And you can see that the consolidation pattern here for the previous pre-cycle high was close to 26 weeks. So it's around 25 weeks. We're hitting that point right now. And I think without a macroeconomic catalyst, I think we would continue to consolidate and form a bottom, and then we would continue up. However, if we do have a negative economic catalyst, we're going to have a potential dump. And I don't think it'll be as significant as it was back in 2019. And the reason why I say that is because we took direct action to close down the economy. We have significant economic issues currently, but we're not going to close down the economy. Business is not going to get shut down. And what the Fed's going to do is they are going to slowly reduce interest rates and hopefully lead us to a soft landing. I don't personally think that's going to happen because I don't have any trust in the Fed. But you can see that we potentially we could have another, 20 to 30% dip if we do have a negative catalyst. So it's something to consider. The patterns are very similar, and it's something to be careful about. And when you do your trades or you conduct your trades, make sure you are hedging yourself. Normally you buy a put or a call. If you don't have that ability, make sure you have good stop losses set up, and you can also, put an inverse trade where you potentially have a short or spot short. There's various different ways you can do it, and maybe I'll make a video on that, on how to potentially hedge yourself in the case of a downturn. All right, so taking a closer look at the current price action over the last 25 weeks, you can see that we have the proverbial bull flag, and that does not mean that we can't go down further or it can't break down. And we do also have a potential widening megaphone pattern as well to take consider of, and that would be in line with a prior resistance area of consolidation, which is at about $53,000. We hit that, we came close back in July, and then we recently just hit it again on Friday. We are starting to recover, and one thing that I think is very useful to take a look at, especially on the higher time frames, is your Tom DeMark indicator. And you can see as we became oversold, we printed a 9. We didn't do one back here, but we did on August 7th, and we did again on 4th of September. So just taking a look at this descending parallel channel, you can see that we are recovering. where we should be, according to technical analysis, which would be predictable outside of something that's abnormal. We are in a descending parallel channel within that bull flag, as you can see. And we do have two CME gaps. One we partially filled, barely. I would even call it a fill. So we do have a CME gap up here, and we do have another small CME gap down here that we did not fill. So those are all things that put into consideration when making your swing trades here. The probability that these gaps get filled is generally high, but again, this is just an indication, and indicators indicate, they do not dictate, so we don't necessarily have to. It's just a high probability that we will. And with the economic data coming out, I can expect to have high volatility. We are in that part of the cycle where we should be expecting high volatility. So we could theoretically have a drop down to 53 to retest, create a double bottom, and then jet back up to fill the CME gap up here, and come back up to about 66K. Now, that's not the exact way the price is going to work its way down and up, but it's probably going to be volatile, and we're going to have large swings depending on the data and the actions of the Fed. Taking a look at our MarketStar for oscillator here, you can see that given where we are on the lower part of the descending parallel channel, the proverbial bull flag, you can see that we did print a green dot. We do have increasing or positive money flow on MicroCipher. VWAP is rising. So the expectation here is that this is in confluence with where we are on the parallel channel, and we should start to head back up. It's not a guarantee. We do have some hidden divergence lines printing here where we have the anchor wave and the trigger wave. It's a little bit weak here, but it is a good sign on the daily chart. You're probably wondering what this green line is, and it is the marker for the expected rate cuts to be introduced by the Federal Reserve. So that is Wednesday, the 18th of September. Now, will Bitcoin react to the Fed introducing a 25-point basis cut? Most likely not. That should already be factored in. Looking at the CME watch tool, they're predicting a 71% chance of a 25-point basis cut. So that should already be factored in the price. If we get a 50-point basis cut, that could signal to traders that there's something wrong in the economy and that the Fed sees something they don't. And it may give rise to slight, I don't want to say panic, but the expectation that there's something more broken within the economy than the rest of the market is currently seeing. And in that case, if people panic, they're going to take away or they're going to sell their assets that have the most risk. Bitcoin is a risk asset, and we're probably going to have a dump. And I would probably expect us to at least come back down to test $53,000. That would fill the lower CME gap. And we potentially, on the positive side, could create a double bottom pattern, which would be good. If the market takes it more adversely than I would expect, then we could test 49K, which was the previous all-time low in the last 6 months. Where we go from there and what breaks the economy, if there's anything, it's going to take a while for the market makers to analyze and see what the Fed is looking at or talking about. So something to consider. All right, diving into the 4-hour chart, you can see that we are back within the descending parallel channel. We did dive below it last Friday. We had a big dump. We tested the low here, which coincided with the larger bull flag. We bounced. We had a higher low, which was a good sign. And it was an indication to buy. And I can show you that on the 1 hour and smaller time frames. It's easy to show, but we came down, came up, hit resistance, came back down, hit resistance again, made a higher low on the 4-hour time frame, and then we broke this resistance line right here. We tested it as support, and that was our signal to take along. I did miss it. And now we are forming a pendant. We did reject off the upper descending parallel channel. That's why these channels are so important. So despite breaking it, we didn't have to delete this parallel channel because it ended up being resistance once we came back in it. And now we are consolidating above this area of supply and above the local point of control. So these are all positive signs on the 4-hour, and that gives you a better picture as we dive deeper. Things look, gives you perspective and things make a little more sense. We are printing a bullish pennant, about a 55% chance of upside based off of that indication alone. Very good looking price action. That's where we're creating a double bottom here in confluence with this supply area, or I'm sorry, demand area. This is a demand area. So all good here. As we get into the smaller time frames, you can see that we have this pink and blue line. That is the 200 exponential moving average and the 50 exponential moving average. And I like to use these on the smaller time frames because they show the trend. And you'll see that here on the 30-minute. And the big thing that I was looking for was a golden cross of the 50 exponential moving average back above the 200 simple moving average. If you look back on the 27th of August on Tuesday, we had a cross of the 50 below the 200, which indicated the trend had changed and that we were going to go lower. And as you can see, we had indications where it wanted to curve back up, but it never crossed. We had, I wouldn't call a fake out because we never confirmed, but on the 3rd of September, it looks like it was going to cross and it didn't. So that's why you always want to have confirmation. And you can see that this was pretty good all the way down to our bottom low on the 30-minute. And we just crossed again on the 9th of September, waited for confirmation the following day on the 10th, which is today. And we've crossed with some significance. So that's all good signs. So we have a nice reversal signal when it comes to the exponential moving averages, a golden cross. We have support on a demand zone above the localized point of control. We are consolidating in a pennant. So these are all good signs. Does that mean that we should buy right now? Potentially. Again, I would always use proper risk management. There's a lot of good structures here. We have multiple indications saying that we have positive future price action and we're probably going to end up testing or breaking out of this parallel channel. Probably have a retest, potentially. We may not. All depends on what happens tomorrow. And I think that's the big key thing here. What happens tomorrow, and the significant event that's going to be happening tomorrow is the announcement of August CPI. So my expectation, I haven't looked at the news yet, but my expectation is that inflation is going to be measured. We're not going to see a significant rise, I don't believe. A lot of people are on the poorer spectrum of the economy are conserving their money. They're not spending a lot of money. And so I don't expect CPI to be measuredly higher. If not, I think it should be a little bit lower than expectations. So somewhere around at expectations or below expectations. Significantly below expectations or significantly higher above expectations is going to be problematic, and you're going to see volatility. And then everything on this chart isn't going to mean anything. So just take that into consideration. If we have a negative news event when it comes to the CPI, we could see a double bottom here. Knock out the CME gap again. It could be a positive thing. as long as we don't have a lower low. We get a lower low, we're going to break other structures and price is going to suffer. So take that into consideration. Would I short here? No, I would not. Once these exponential moving averages have crossed on the 30-minute, you want to buy on the pullbacks. If you're going to short with your trend indicator, again, there's multiple trend indicators you can take a look at. The one I like to use, again, is the 50 and the 200 exponential moving average. Your risk reward is going to be reduced. So just take that into consideration. So that is my analysis of Bitcoin through the 2-month to the 30-minute chart. If you have any questions, I'm going to take a look at some of the other charts. Probably take a look at AVAX and Beam. Those are 2 other coins that I own and I think I would like to trade on leverage or just buy more in spot. So I hope you enjoyed this analysis of Bitcoin and I hope you have a great day. All right, thanks. Bye.